Finish up the day, final hour session, and look, I used this similar thumbnail to this last week. Last one was, I think it said just September correction or something like that. Now we're doing September reality check, and now we're doing September history lesson. I just want to make it very clear. It's like this is what I expected. We talked about September being one of the weakest months of the year for a 10-year average, usually about 1 to 2% lower in September. Usually following a like a blockbuster type August, like we saw this year. August was nearly at 3%. September, like we saw back in 2020, was down about 65% of that gain. So, what we've given May rally, June rally, July rally, August rally, I expect September to chew in that to a little bit. Again, it might be chewing into it with just volatility. It may not close negative for the month, but I would at least expect to see some levels get hit on our charts. So having a look at the S&P, having a look at the Nasdaq, here we are. The S&P just opened today and closing today right below the 21-day moving average. So it's minor, but you can see the market kind of fought back for the day. We actually had like a pretty calm day overall despite the nasty like 5 minute candle when we opened up. So open up the day, immediately went all the way down to like 100 and plus, 120, 150% ATR. We had one big 5 minute candle, came back and retested it, came down and retested the lows, broke slightly lower. But for the most part, we opened the day here and we are right there closing the day. So the markets really didn't move that much as far as net intraday movement. We're trading right around 6,400, and that's likely going to be somewhere within probably plus or minus 10 points. We're closing out for the day. We're in the final 30 minutes. So where are we at? We're just below the 21 period moving average. So we have the 21-day moving average. We have our 50-day moving average. This is what I've been talking about for the last probably 3-4 weeks is we're running, running, running. We're likely going to have price action, find this 50-period moving average, I would imagine, through this month. If it takes any longer, I guess through October, but I'm a little perplexed that it's taken this long. Last time we got above the 50-day moving average was back here on April 30th. And from that point, we have gone 85 bars. That is a long time. Usually this is on average like, maybe 50 or 60 bars before we come back and test it. The fact we've gone, nearly 300 points above it. I think at one point we were up to like 270 points. That was about 290 points above the 50-day moving average. You can see that it did pull back to it. Same thing here. Market was up around 260 points above it, pulled back again briefly. And then same thing here with the high from Thursday last week. We were up around 200 and let's say 10 to 15 points. Now, pattern wise, I talked about this in the video that I posted yesterday. If we have a 3-drive pattern, okay, either this is a 1, 2, 3, 4, and 5 that we're expecting an ABC correction with. On top of that, we have a 3-drive pattern, which is 1, 2, 3, 4, 5. If this structure breaks, which let me use a slightly straighter trend line. If this structure breaks right in here, which it is closing below this right now, I wouldn't be surprised to see that the top is in for right now. This is a break of structure. If we do not close back above 6,500, I think this is a resistance level that traders will see some lower prices from here. It's probably better just to get it out of the way and let this market pull back a little bit, and hopefully we find some decent support in the, let's say, 6,200 to 6,000 zone on the SPX. We've got all sorts of dynamic moving averages between the 50, the 100, the 144, and the 200. This is the pullback window that I was talking about when we first had this. We first had this July 31st top, August 1st bottom. That was the 4 to 5% correction I was looking for. I mean, I expected price to go something like this: high to low, lower high, lower low, find the correction, and then the melt up can ensue once again. But we haven't. We kicked the can down the road. It's now a little bit longer in the tooth, a little bit more overextended, a little bit more overbought, and a little bit more divergence lining up. So with this candle here, if the market's going to continue to slide, we're probably going to head lower. There's a 50, there's a 100. If I'm looking to buy some dips, it's in this area. Waterfall income trade today, we gave ourselves a nice little buffer. We got a 15% buffer from current price, which means we can let the market fall almost 20% from the recent all-time highs before we take on any risk. And we put on 2 trades today, one on the SPY, one on the QQQ. We also had 2 closed out trades from last week on daily profit play. We took some nice. We had some broker issues this morning. It took me almost like 30 minutes to get into my Tasty Trade account this morning. They were having some like connection issues or whatever. But eventually trades were fine. I just did get filled on daily profit play. But fortunately, we took trades last week, and those were 2 winners. I had an entry FOREX. We had a couple of trades in daily profit play. It was an entry for $1.10 credit, close for 20 cents debit, an entry for $1.20 credit, and close for 20 cents credit. So those are pretty good winners. Taking 90 home out of 110, you pulled in 82% of that max credit, and pulling in 100 out of 120, you pulled in 83% of that max credit. So overall, those are pretty good returns, and happy to take those trades. We took the trades on Thursday, Friday last week. They closed out today. The benefit was we had a longer weekend with Monday being a holiday and the markets were closed and everything opened up lower today. So it put all of our deltas further out of the money, which was good for our trades. And we took a nice chunk of profit there. So over 80% of the max credit on those 2 trades. It was nice to have those trades because with the broker issues this morning and not logging in, I essentially had all pending orders today that didn't get filled. So my standard, daily profit play and my plan was kind of disrupted by not having. I'll go ahead and delete this now, but not having a broker connection that allowed me to take any trades. I was on the Thinkorswim platform, put in pending orders, none of them filled. I got on my Tasty Trade account just after 10 a.m. Eastern time, put in the trades, and none of them filled. So it's fine. It was unfortunately like a little connection issue that could get me filled for a 0 DT. But price overall did not do a lot. It was a big gap to the downside, probably caught the market off guard a little bit. I am wondering if the VIX, again, like vol suppression is a real thing. If we're not making a rip from 19 above, if we don't get to like 20 plus, then this still allows volatility suppression ones to do exactly that and suppress volatility. And going from a 19 plus VIX down to 17 today tells me that we might see volatility just return right back down. I am skeptical just based on where we are at. I think that September is a bit of a self-fulfilling month where historically it is usually bearish. So let's go to, I showed this last week in a video. I'll show you the data. We've got a 10-year average here. So just give me a second. Let's go here. There we go. All right, so let's go to seasonality, monthly. So looking at the Nasdaq right here, you can see that August and September. So we're in September right now, just starting out. The average 10-year print for a month to month for September is negative 0.75% in the Nasdaq. Now, that means that the close from open to close for the month is usually down negative 0.5% on average. For the month of October, you can see it's also a negative 10-year average. So this is the weakest window for the year in the Nasdaq, September to October. Now, does that mean the market could pull back 5, 6, 7, 8, 9, 10%? Yes, but it could go down, 5, 6, 7, 8, 9%, and then come back to finish maybe flat or maybe still down like 1 or 2%. But the volatility is likely going to increase if we're seeing the market roll over a little bit. I just think that the faster this correction comes, probably the more reflexive it will get. I don't think the market's going to roll over through, November, December. I think that you have concerns. I mean, the job market's going to post non-farm payroll on Friday. The numbers don't look fantastic. I think the forecast is about 75K. So here is the U.S. non-farm numbers for Friday, right in here. So unemployment rate expected to go higher to 4.3. Jobs number previous was 73K, forecast for 75. This print of less than 100K is showing that there's essentially a stall in jobs. We're not falling off a cliff. We're not seeing the unemployment rate balloon to 4.5, 4.6, 4.7. But over the next, 2, 3, 4 non-farm payroll prints, I mean, if this is going from 4.2 to 4.5 or 4.6, that's not a good sign either. This is where the market's, starting to show some concern with the labor market, right? So if the labor market's a concern, what does that mean? Well, probably people are going to be cutting back spending. People are going to be worried about jobs. I think you can still get a job in the U.S. It may not be, like everyone's doing during COVID, which is I'm going to work from home and take on 4 1099 gigs and, double and triple my earnings because I'm just working more, but doing it with 1099s. Um, Companies have made a big push to get people back in the office, W-2 positions, and they've cut down on kind of that double and triple dipping with 1099s. But it's a gig economy as well, and people do what they want. But it's a lackluster expectation for jobs. Average hourly earnings at 0.3%, and we will see what the print is on Friday. This is Friday's non-farm. This is also why the Fed, based on what Powell said at Jackson Hole, is probably why the Fed's going to be starting to cut in September. Um, I think what would be a pretty scary event, just based on the surprise to the market, would be if the Fed September 17th changes this expectation to a 25 basis points cut, which is now 92%, 91.7 to be exact. But if we cut in September, but we surprise the market with a 50 basis points cut. Okay, I don't think that's going to happen. Based on this is a very accurate tool to use based on what the Fed is going to do. The next rate decision is September 17th. There's a 91.7% chance that the Fed is going to cut one time, 25 basis points once. Now, if they cut in September, looks like there is a split right now between pausing in October or potentially cutting in October. You can see, if you want me to zoom in here, okay, 48.9% chance that they pause, if you follow my mouse here, or a 47% chance that they cut another 25 basis points. So let's say that they cut here in September, and then they cut again in October, and then they cut again in December. Let's say that we go September, October, December, cut, cut, cut. So we're down 3 cuts already to finish out this year. And then we have what? Maybe a pause through Q1 and then another cut here, and maybe 1 or 2 more cuts by the end of the year. So that'd be another 2 cuts in 2026. It still works out to be about the same thing. 5 cuts in total by the end of 2026, right? But the difference is, are we going to cut all 25 basis points, or is the market going to be taken into a surprise move with a 50 basis points cut? I don't know, but this tool is usually not wrong. It hasn't been wrong since like 2008. This is the problem with it, though, is it's all transparency all the time. Whatever the Fed does, this changes. The futures market changes it. The odds change. And it's like, despite the transparency, this can change literally the day of FOMC. And last year in September, you can see the market overreacted to that because this did show, by the way, this showed like the higher probability was a 50 basis points cut in September. And it, in fact, gave us that. The Fed did cut 50 basis points in September. The market didn't love it. Market was down initially and then recovered through September. I want to say September of last year, I think, was a positive month. It was like a little bit of a Labor Day lull. Then it just went right back to highs again. Let's go SPX monthly. Let me go back to monthly candle September of 2024. It would have been this little hiccup here. That's October. Yeah, look at this thing. So the market was scared by that cut and it still went down. So volatility, this is what I'm talking about. This is the volatility where the month itself was down. So we opened here, we were down through Labor Day around 4%. Well, a 4% correction ended up finishing the month positive by 2.5%. And that was also coming off of a May, June, July, August to September rally. So a lot of volatility in August, September of last year. That was that 10% correction. If you remember this looks a lot different on the daily or weekly chart because we started out with a high in July and a low in August. That was about a 10% correction. And that correction was still just like, who cares? Who cares? And we finally had a pause. We ripped into the election. But it was based on that aggressive, like July, August low. The market still finished a positive September. I think it's a little different going into 2025 because we've had such a strong May, June, July, August. Something tells me that even September is going to start off on a rough foot. Again, it may not close negative, but I would at least expect to see some type of wick to the downside and see where those dips are at. Previous all-time highs, maybe a chance to buy some dips. A little bit lower than that, maybe a chance to buy some dips. Maybe September is a red month when it closes, but October to December, how do we finish? We will find out. Okay. All right. So what's coming up this week? Non-farm payroll on Friday. That's usually the high impact news for the first week of the month. What do we have this week? We have ADP numbers on Thursday. We have ISM services PMI on Thursday as well. Friday, non-farm payroll. Okay. So today we had manufacturing PMI came in 48.7, forecasted 49, but better than previous. Let's see, your Aussie GDP, US JOLTS job openings on Wednesday. We'll see what that prints. And then Thursday for ADP, that's usually the non-farm precursor plus unemployment claims. Are we going higher or lower? I don't think it's going to be a huge deal. I think all eyes are going to be on Friday's numbers to see, look at the Fed Watch tool. It's 91.7% chance they're going to cut 25 basis points. Does this change at all by Friday? Does it change to a higher probability that they're just going to cut 25 basis points? Does it change to a lower probability that possibly even, this is one thing we could see, go back to 100% here, we could also see this. Okay. What if by the time we get to Friday, what if we have this is a pause at 8.3%? This is the cut of 91.7. What if we print another column over here where this goes down and then maybe this goes down and this all of a sudden pops up another histogram and says maybe there's a 10% chance of a 50 basis points cut, right? These are the crazy things the market could do. And does that do anything for immediate price action? Maybe, maybe not. But I think that this is going to be more disruptive. If we cut by 50 basis points, it's probably more disruptive. We cut by 25, it's just part of the transparent plan the Fed has rolled out. They've been reluctant to cut. I think there's clearly a lot of pressure coming from Trump and company, and that the Fed is a little bit too late with monetary policy, maybe making some missteps, maybe taking too long. And that has allowed the economy to slow a little bit on the job side. If we slow on the job side, that's not good because all of a sudden consumers start to pull back and we could have that dichotomy of Wall Street could still be growing and Main Street could be struggling. And that's not usually a good thing. You want to see in good times and good bull markets, you want to see people are happy, people are working, people are making money, people are investing, people are participating instead of I'm overextended, I'm strapped for cash, I can't afford to live the standard of living, I'm going to cut back and stop spending money. And meanwhile, Wall Street is like all-time highs, all-time margins, we're killing it, AI is the future, blah, blah, blah. Right? So there could be some volatility there. This is also why I talk through some of these core strategies. My waterfall income, for example, my strategy 2 allows us to play a 10 to 15 to sometimes even a 20% buffer before we take on any risk and we still generate really consistent income. Okay. So this is what I did today. I took 2 trades on waterfall income. Today we had the broker connection issue, so I didn't get the live trades on Daily Profit Play, but we took 2 winners from last week for profit. I'm trying to think. I've got a masterclass on Wednesday, Thursday for double ups. We had a super active week last week at Pitch Point. We ended up taking like 8 or 9 new trades last week with my scanner. Also added in another crash insurance. I did this. Actually, the crash insurance I put in last week is out to April or June. Let me check this right here. April or June of 2026. I think I did it on SPY. Let me double check this. Maybe I did it on SPX or did I do it on futures? I might have done futures. Let me check here. So futures, December 31st. That's micro. All right. It must have been a SPY trade then. Yep. So right there. So I did a June 18th of next summer. So I did a 500 by 345. That is a $5 debit that potentially pays, if I'm trying to think here, that is 1655. Oops. So potentially it'd be 165 times 100. I can make $16,500 on this trade and only risking $500. So, I mean, net, I basically can make about 16K. And again, the odds of making 16K are pretty slim, but 16K out of a $500 risk, that's a 32 times hedge. So I can risk 500 to make 16K. That's 32 times my risk, which is obviously a nice monster hedge. However, the way I plan on using the hedge is if I can take a $500 risk and it could turn into, let's say, $2,500 profit, maybe $5,000 profit, a third of what's potential, I'd still be happy with that as a trade. Because what I'm really hedging for is maybe a 10% correction. If we have a 5 or 10% correction in the market, I would probably take the hedge off. And there should be enough wiggle room in this spread being 155 points wide that to actually be, I did that math wrong. It's 15.5. So I can make about $15,000 on the trade for risking 500. So it's about a 30 times reward to risk. But the reality is if I'm risking $500 and I can make, let's say $2,000, $3,000, $4,000, $5,000 pulling in, a fraction of that max profit, it still allows me to offset a decent chunk. Because if I did that on all of my accounts here, let's say that each trade was able to see like $2,500 in profit. That would be $2,500. I mean, that's $40,000 to help buffer my bottom line. I mean, it doesn't mean I'm going to be in profit. I might have like a bigger drawdowns from some of my overall positions and some naked options that I have. But if I can buffer $40,000 in hedges, well, that's $40,000 I don't have to make up for. That's $40,000 that if I actually participate in the dip and start trading more through any type of drawdowns or dips, that's more upside I can have. Right? Here's an example. You draw this out on a chart, something like this. If the market is okay in April, when the market was down, I was actively trading through March and April. Okay. A lot of those trades paid out really well through May and June and July and even into August. That was just pure melt up. All these trades through all of these participating weeks, it paid pretty well. I wasn't super active. When we got into July, I was backing off, I was raising more cash, and I wasn't as aggressive. I still had the benefits of an all time high multiple times in July, again in August, but I wasn't actively participating in new all time high type trades. So I was heavily participating down here. What I'm saying is, let's say we fast forward to a correction. If the market corrects, let's say 10%, okay? If that's 10% that I can start hedging and I can get some profits in here and the market finds a low and works its way back up to highs again, that's the ability to have some gains on the way down and also have gains as I participate through that dip, hopefully gains on the way back up. So well before we get again to the all-time highs, I can still be hitting all-time highs in my portfolio. So the idea is my P&L is hopefully going to be something like this. When the market is down, I want my maybe dip to be minor. I want to have hedging to help offset some of that drawdown. And then we go up, we see a nice big chunk because I participated as the market was down and all these positions pay out. And then same thing here, you start to hedge, you maybe have a little bit of a dip in P&L, but again, as it dips and tries to work its way back up, you can hit some new all-time highs. So my balance can be, doing well, fighting and defending against a dip, and then doing well, fighting, defending a dip, and then doing well. So I'm trying in the best of my ability is making sure that when the market is down here, I'm not experiencing the same type of dip in my account. When the market's down here, I'm not experiencing the same type of dip in my account. Right? That's where crash insurance to me is the most important thing. If the market's going to be down 10%, I want to be down maybe 2 to 3% if I can be. It's not perfect, it's not easy. But I also lose on hedges too. But if I had a hedge that can pay me, 30 to 1 and I can close it out for 2 to 1, 3 to 1, 5 to 1 even, that still is a worthwhile hedge. Okay. It doesn't take a lot of hedges to be right to, cover that as like an insurance play when ultimately the market's trying to go higher. Okay. All right. We also had this trade here. This was a trade for waterfall income. This trade closed out for profit last week. We have a trade that's running to the 919. We closed that one out. This one's out to 930. I'm keeping that one open so I can delete this 829 waterfall call Condor. That trade is done for profit. Last week, we had $160 income on that one. Ended up closing out for $2.20, so $220 income, which is a little bit of a bonus trap. This one's out to the end of the month at 66.40. And the trade I closed out today was up to 6,700. All that means is I was essentially calling the top through September. We're getting a bit of a pause here. The market's been reluctant to go much higher than 6,500. And I'm hoping that it kind of stays this way. I'm hoping that now that we've rolled over a little bit, that we can work our way down to the 50-day moving average, work our way down to maybe previous all-time highs. The dips for buyers and bulls can be somewhere in here and see if the market can get back to these highs. Okay. It wouldn't surprise me for an A, B, C, D correction. If this is the chance to buy the low, then we get back up to the highs again. Does the trend go higher or do we go back down and back up and we have to wait for another cycle? I still think the market is probably dead set on trying to get to 7,000. It may not be in 2025, but it wouldn't be terribly surprising through probably fall of next year if 7,000 is in the cards. Unless the US is going to completely go backwards on tariffs or completely go back on spending and deregulating and having fiscal and monetary policy working in conjunction with each other, I don't think we're going back. So, I think a correction is needed. I think a little ventilation, a little pullback is totally acceptable. But I don't think that the narrative and the agenda changes. So unless, Trump and the Republicans absolutely get demolished during the midterms in 2026, I don't think much changes. And the labor market is a bit of a concern, but if people can see that, okay, the Fed is cutting rates, what happens to our 10-year yield? Well, 10-year yields jumped up. Bonds actually dropped today. This is what I think is going to be one of the more important charts. It might be super boring to watch this garbage, but one of the more important charts I'll be paying attention to through the rest of this year is if and when the Fed starts cutting rates. If the Fed is cutting rates by 125 BPS, I guess I'll just put percent. Okay, by 1.25% lower rates. That is on the short end of the curve, not the long end. So if they cut by 125, does that mean that this goes up by 125 or this goes down by 125? That is a $40 trillion question because that's essentially the global debt that needs to be refinanced in these next probably 1 to 2 years. So it's a big deal. We had last year not cooperate, right? Fed cuts by 100 basis points, market and the bond yields go up by 100 basis points. The stock market still went to all-time highs. It didn't really derail the markets at all, but it was also, this was pretty disruptive through October, which we had a flat month, and it wasn't until the election that things started to go much higher. But that was after the cut cycle started in September. So how this all plays out over the next probably 3 to 6 months going into 2026, it will be very interesting. I don't know. Okay. But the bond market is going to, probably give us some clues on whether or not we can see the ability to sustain these highs and these valuations by probably seeing this. If the market maintains a 10-year yield that is still range bound, then the market will be fine. But if we see this and borrowing costs look like they're going higher, that I think at this point, probably around the 4.7, 4.8 or higher, this is going to choke out growth. It's going to be difficult to grow at a 10-year yield at 4.8, 4.9, depending on how fast it gets there. The market can absorb a lot of this. Higher yields, stubborn yields, the market can absorb that. The market doesn't like this. The market doesn't like this. The market doesn't like this, right? It doesn't like these aggressive rate of changes that we see in some of these instruments. If it happens in the bond market, it happens in the yields, things are blowing up left and right if that's the case. This is all about stability. Okay. All right. Rate cuts good for bank stocks. I don't know. They're not supposed to be. They're not supposed to be. But I mean, financials have been leading the way here. Here's the XLF. This is financial sector. Since we had our little, fallout here, and then the last time XLF was maybe affected would have been, this was the regional bank crisis back in here. This would have been January to March of 2023. Regional bank crisis. XLF has been on a freaking tear. And part of this is because it's a sector. It's weighted with the too big to fail banks. So even a regional sector crisis, the Fed essentially backstopped it. Big banks like Wells Fargo, Bank of America, JP Morgan stepped in to assume the risk and liabilities. And XLF as a sector is up 77% since January of 2023. Okay. I think that there's a lot of resiliency to this. I think that if you're interested in trading XLF, it's going to be pretty boring. It's not a high flying sector, but if it pulls back, it's probably resilient. I mean, if you're looking at who does well, I mean, type in any bank. I'll show you. Here is some fundamental analysis. I don't see banks. I don't see stocks individually on a snowflake analysis look any better than banks. Look at Bank of America, BAC. Okay, beautiful. Like, sure, is it value? Is it future growth? But it's super financially healthy. Past performance is indicative of most likely future gains. It's steady, it's stable, and there's a decent dividend that's respectable. It's also trading below estimated value based on discounted cash flow. It looks pretty good. Now, does it always go up? Of course not. There could be volatility along the way, but look at the chart. Look at BAC. Okay, after a big correction in April, it's back above, and we're now in a nice buy zone, all trending to the upside. If it pulls back, I look for this to be dynamic support, dynamic support, dynamic support, dynamic support. It's slow enough that it probably has those buy dips, right? Like you buy the dips on those moving averages, it's a great place to position for it. So that's BAC. We're in an uptrend. Everything's crossed over. All things are stacked up to the upside. 21, 50, 100, 144, 200, all facing up. We pull back, it's probably a buy the dip. Okay, go to Wells Fargo, WFC. Same thing here. We had a nasty correction in April, back above it. Everything stacked back up. Everything is positive. Coming in from these lows. Regional bank crisis, 2023. $38 up to $81. You're talking an individual bank stock that is up 130%. This is insane. Look at Goldman Sachs, for crying out loud. Regional bank crisis, all the way back here at $300. It has doubled. Okay, 140%. It's crazy. Does that mean I'm bearish? Of course not. Like, these are why would you be bearish on this? Right? If anything, it's like, okay, pull back. Pull back here. Pull back here. Pull back here. Find some dynamic support. If it offers a pullback, then buy the dips. They're fundamentally as good as anything I can find. So, a too big to fail bank probably is okay. There's other, you don't have to trade it, but Goldman Sachs is not going to be just running like crazy, but fundamentally, Bank of America was better. Wells Fargo, WFC, Wells Fargo, fundamentals pretty good. JP Morgan, fundamentally pretty good, right? Some of the regionals are surprising. I'm trying to think, like Huntington Bank, HBAN. Look at this thing. Like, this is a regional bank, but it just looks so good fundamentally. So, and meanwhile, the stock hasn't performed that well. The stock had a dip to $12, but it's already up. $12, it's up 50% from the bottom. Longer term, does this stack have what it takes to break and go back to these recent all-time highs? If you're looking for growth opportunities, how about this one? It's a slow trend. It's a slow trend, but I would say if this is a channel, just technically speaking, if we just parallel this thing out, does it go higher? Maybe. Does it pull back to the midpoint? Right? Does it stay into like a trend like this where it stays on the upper end of this channel? Do we have the ability to get to these recent all-time highs? If I could buy the stock at 17 and go up to 24, it might not seem like a lot, but as a percentage gain, if this goes up 44%, there's not a lot of investments I would say I can find that right now with a high conviction. So 44% upwards of all-time highs at 75%. Yeah, I'd say it looks pretty good. What about all-time highs? What about discounted cash flow? Price target of $27. Those all-time highs at 30. Can we overshoot to the upside? Maybe. What would I do? Well, if I position here, I want to look for chances to buy dips. So if I said trade 1 and it pulls back into this dynamic support, that's trade 2, pulls back into support, trade 3. Maintain this trade. So if I can buy, let's say, $1,000 here, $1,000 here, and $1,000 here, I've got $3K invested at a break even in the midpoint, and it goes up to all-time highs. That's 40+% return, right? From here, with a cost average that's a little bit better, I could maybe have a 100+% gain. So, realistically, I could see the stock like doubling my money. It's just going to take longer because it's not a high flying tech stock. Okay. But if it also offers a 6% dividend and the stock price can go up by, 50 to 100%, like that's a pretty good position. So it's not risk-free, right? Nothing is. If we have a crazy credit crunch or we have some type of debt issue that maybe a small debt bubble that needs to be deleveraged, then I'm sure financials don't do well. But if we just keep pumping liquidity into the system, money flow keeps money supply keeps increasing. It's hard for banks not to see the benefit. It's a little trickier to trade like regional banks versus the too big to fails. But this one didn't fail in 2023. This one, I don't know. It's all about like bonds and durations too. So it's not without risk. But as far as something like steady, even if this thing just did 6%, that's better than nothing if it doesn't lose appreciation. If we stay at like $17 and we get 6% on that, you're not losing. If it goes to if it goes back to highs, you're getting a 6% kicker on top of the growth. That's a great trade. That's a high powered dividend stock if you get something like that. So just food for thought. That's all I'm saying. All right. Morgan Stanley projections at 72. Yeah, I can see 7,000. I can see 7,000 into 2026. I can see the market any dip offering a chance to buy. I think people are underestimating that when you have fiscal and monetary policy on the same side and on the same team, that usually bodes well for stocks. And it might be annoying. It might be like, this market has not never pulled back. It barely pulls back, right? It might not pull back. We might have like a couple percent here and there. I mean, look, this is why I'm saying that September would just be a nice window. Get the technical side satisfied, satisfy this 80 plus bar count on the 50-day, pull back for one of the worst. It's like a telegraph. Just the market knows that September is usually a bad month. Just get it over with. Get it over with. Offer traders a chance to buy the dip. If you got some near-term hedges, maybe you can make a few bucks on that, but give us a dip that we're happy accepting, right? Maybe the dip is combination of non-farm payroll, higher inflation, and an FOMC. All that month, it's noise, but it ends up going lower. I'm still interested in buying the dip. 4 to 5%, I'll position with options. I'm not going to just bet the farm on a dip. What if the market comes all the way back down and gives back some of these gains from April's low? Well, I want to get as much cushion as possible, which is why I'm doing this for waterfall income. This is why we have about 15 to 20% buffer before we take on any real risk. Okay. So there's a lot of ways to do it. I'm hoping we have a dip that we can participate in. I'm hoping that this market is not just going to go back to all-time highs. I think we stay here. One thing, I'll just zoom in one more time and kind of revisiting this. If this is a rising wedge or this is a 3-drive pattern, this trend line based on today's close, it closed below the trend line. Even if this market makes its way back up into this gap and it fails, okay, I think this thing turns the corner. So I say this a lot in my daily profit room. I'm paying attention probably way too closely to day-to-day price, but when you're trading 0 DTE, you got to pay attention to that crap. So if we go up tomorrow, don't be surprised if the market fails at some point this week and still starts to head lower, right? So if we can sell high day to day, I'm hoping that provides a nice little income track for us. All right. So we've broken and we've closed below the 21-day moving average. Okay, fine. What's next? Well, we can obviously come back and find this gap. We can fail off that gap and head back down and find the 50-day. Does it all happen in this week's trading? I don't know. But I would say that my better probability is that we at least find this moving average, maybe even this moving average in September and October. So if I gave myself about 60 days to be right, I can probably find price at least correcting to a point where I can make some type of near-term bet to the downside and also be patiently waiting to buy some dips at a better price versus just buying all-time highs and hoping the market goes higher. That to me is like the worst trade in the world. I know that they're like, oh, what happens after all-time highs? More all-time highs. Right. But every time we get an all-time high and the market pulls back, I want to have cash to buy the dip instead of I just have to wait for the market to go higher to make money. I want to take advantage of dips. I want to be at all-time highs in my portfolio before we get back to all-time highs in the stock market. So dry powder helps. Okay. All right. What else? Quad witching in the 19th. It's not going to matter. Maddie's asking about, it's a quadruple witching. We're going to have indexes and VIX and futures and stock options all expiring on the 19th. It's not going to matter. It's going to be, this is the biggest nominal expiration ever in the history. It's been that way every month for the last year. So it's going to be this big crazy number. It's going to be like $6 or $7 trillion at expiration. Price is going to be doing the same crap it always does. It might go up or down for the day. It doesn't really matter. Take the day for what it is. September historically is a negative month. Okay. So Nasdaq usually down about 0.75% for the average 10-year. Okay. Over 10 years, it averages down about 0.75%. The S&P average is down over 1%. Negative 1.04. And also in October, also a negative month. So between September and October, if there is a correction coming, this is the perfect correction window to get it. Okay. All right. What else? If my grandpa gambled land back in the 60s, I don't see why I wouldn't on the NASDAQ. I mean, I still like the dips, man. I mean, even NASDAQ, it's like, look, if we're going to maintain a well-supported market, if flows remain steady and money supply continues to go up, it's hard to change that liquidity in the system. There are forced buyers to the tune of like $1 to $2 trillion every single month. Okay. There's a bit of a blackout in buybacks right now. We're going to have another earnings season kickoff in the next probably 3-4 weeks as things get, more important for October. And we'll trade that too. But right now it's like, this is just an interesting lull where it's like people are just getting back to work. Kids are back in school, back to the trading desk. Any positions that have been crappy for the year are typically dumped. This is what tax loss harvest is all about, is you just dump your positions for what's not working, your dead capital that's costing you money, just close out. Take those losses, write them off against your gains, and then ride these winners out to the end of the year. So I think dips are bought. It's just I hope we have a meaningful correction that gives us something between maybe 5%, maybe 5 and 10%. I'd be excited to buy the dip. It's not going to feel good. I can promise you that it's not going to feel good. If we get a 10% correction, it's not going to feel good. But if we have a correction, it's at least a starting point to take some chances. Gold breaking all-time highs. Do I love it? Sure. Am I up higher in gold? Yes. Do I have some new highs in the portfolio? Pretty darn close. I mean, what's interesting is we're a couple percent off the all-time highs in the S&P, and I'm only like $100 off of my highs for the year. So a lot of that today, if I look at my positions for today, a lot of that for P&L is Bitcoin making a nice little recovery. So I'm up 7K today in Bitcoin. SLV making a nice run, 37 and change. That's up $6,200. MicroStrategy making a nice recovery. Gold. So I mean, my shares of gold, my shares of silver, my shares of Bitcoin making a nice intraday pop. Baidu, actually not sucking for once. Apple's okay. But yeah, I mean, I like gold. I still think the correction is driving me a little bit crazy that we haven't hit the 200 moving average yet. Depending on how aggressive gold runs, I'm just being cautious of one thing. This window as a correction is probably going to get hit. So if we make a runaway move on gold, here's what's going to be important to watch for the week. If gold runs and looks like it doesn't want to stop, I don't know where this thing stops. I truly don't. But eventually, when this ridiculous rip on gold is going to top out, we're going to see a pretty nasty correction, probably back down to this 200 moving average. Okay, I put this here and I labeled this line. This is gold capitulation, 30% from dip, similar to 2009 to 11. We had over 600 bars in that 2-year period where the market in gold went above the 200 moving average and did not hit it for over 600 bars. Right now, we are creeping up on 500 bars. So could this stay stretched longer? Yes. But eventually, if it stays so far stretched and we hit a huge like 25 to 30% above and beyond the 200 moving average, it's probably going to come back in a nasty fashion. You rarely see stocks that do this. It blows the top off like so, and it runs like this and then goes unchecked. This next run could be great and exciting, and then all of a sudden it goes toppy and then comes back down in a blaze of glory. And if you're left holding the bag, you're going to hate the fact that you didn't take profit. All right. So I'm not saying I'm not believing the gold rally, but if this wants to come back and retest and offer another dip, like let's see if this can maintain some bullish posture. Because what I don't want to see is this be a fake out and it just comes back down and we just find more range support and then we buy the dip later to get a better position. Obviously, I'd much rather buy the dip on gold. Unfortunately, we just don't have a dip. It's just been up, 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 and now we're breaking all-time highs again. So I think it's a good one to be positioned for. I have some option trades in that are looking pretty good. I've got them out to like December, January, and March expirations. I'll let those run. But my forgiveness is, gold can come all the way back to this 144 and 200 moving average before I'd ever have any real risk. So a run up is great. Silver, same thing. Silver's breaking. We're at $40 now on spot price. Silver to me, I am all towards all-time highs. I'm not going to dump my silver positions until we hit all-time highs. So if we hit $48, $49, $50 spot price, I'll start shaving down my SLV and my silver futures. But that to me technically is where we're going. It's not that far away. This is a nice measure move. What's kind of cool about this is even from a metal standpoint, going up another 17%, I love it. I'd love it. Gold, we're already at all-time highs. Where do we go? Throw a round number out there like, oh, gold's going to hit 4,000. I mean, 4,000. Okay, fine. What's that mean per ounce? Gold will be up another, 13%. Cool. But the fact that it's been just crazy from these 2022 lows, it has been a pretty impressive run. 1,600 to now 35. I mean, we're up over 100% on gold. Right. So gold's had a heck of a run. We hit 4,000 an ounce. I mean, it's up 144%. There have been individual stocks that have outperformed that, but as a safety net, as an inflation hedge, as an anti-dollar trade, as an anti-fiat trade, gold is getting a lot of love as a global asset. And I think it's as good a time as any to probably see the institutional side and the country side has been buying gold like crazy. The retail side has really not been crazy aggressive, which I think is interesting. Like the retail side might just be the reason this thing gets into a bubble and rips to crazy highs, and then the retail crowd gets stuck holding the bag at a bubbly top. So all I'm saying is if this gets parabolic, trailing stop losses would be great. Don't get caught with this thing going up to 4,000 plus and then crashing down $1,000. You don't want to get stuck in that. Okay, so I think we just pay attention to it. Bitcoin back to 111. We are down to 107. This hit a nice little trend line around the 144 moving average. Could we pull back a little bit more? Sure. But if we bounce off the 144, the 200 moving average, this is still pretty well supported. So I still like bullish on Bitcoin. Sell off for market makers? No. I mean, Janelle, I've literally been talking about the sell off for the last month or two. I'm just thinking technically we need to have it. We need to have a little bit of a correction. It's like month to month, this market's been nonstop bullish since the bottom in April. So May was a rip, June was a rip, July, August, all of them are bullish months. It's just overbought with divergence. The market needs a pullback. And what's the pullback? September effect right now seems to be enough. Maybe September effect with some lousy US data. Maybe that's enough. That's enough. And from there, it's like, okay, well, Fed's cutting rates. Does that help? Does that help, invigorate some confidence back into the US consumer? Maybe, I don't know, but it just needs to happen. So sometimes when it just goes longer, I mean, this was weeks longer than I expected to see the market keep making all-time highs. But like I said, from a technical standpoint, we have a rising wedge, which we're breaking. We also have a 3-drive pattern, which is potentially breaking this structure. So if we break this low, we're probably falling to the base of this. So somewhere in here, or somewhere in here, or somewhere in here, potential support, potential support, potential support. I like buying the dips there. We get dips, I'm going to buy some dips. I'm going to position for those dips. Okay, I'm long Bitcoin, but if gold does offer a pullback, I wouldn't mind getting some. Agree. Yeah, I like pullbacks in both. Bitcoin is pulling back, gold isn't. So that's an interesting mix if you go gold versus Bitcoin. Okay, this last little rally here from mid-August, I mean, gold has been outperforming. So what will be interesting is, I mean, I don't know if this is going to be a technical pattern here, but what if we have gold outperforming and then we hit resistance and then Bitcoin outperforms and we come back into making some fresh lows, right? Maybe something like this. Maybe Bitcoin, which would be my secondary cross here. If we go back down to a 0.02, whatever this correlation is, I mean, I'd love to see Bitcoin have like a more volatile run to the upside, right? But maybe gold is the bee's knees for the next 3 to 6 months. I think Bitcoin's still fine. I think they offer kind of the same alternative. One is just a little bit more future focused, a little bit more AI focused, and maybe benefit from AI adoption. But I like both. I think they're good alternatives. Okay. All right. So again, I said seasonality wise, S&P expected to be down about 1% for the month of September. It doesn't come with a lack of volatility. Like I showed you from last year, we had like a 4% dip after a 10% dip through July, August. So September can be a volatile month. This is like the perfect little weakness window in the trading markets for the year. So September, October, difficult probably to make all-time highs unless we have like a nasty fall and then it's a reflexive rally to push us right back to highs. So I'm trying to be patient, let the market pull back a little bit, participate in some dips, have some hedges running, and see where we can, take some good trades. Okay. All right. I'll let you go. I know we got on late today, but thanks for jumping in.